Hi, everyone. I am Blake Murphy, a financial advisor and vice president with California Wealth Transitions. One of my partners, Keith Brandt, is on as well and will be monitoring any questions that get submitted. We're a financial planning and investment-based firm that's based in Southern California, and thanks for joining today's webinar. During the discussion, if you have a question, please submit it using the Q&A function at the bottom of your window. Our speaker today is Apollo Lupescu. Apollo is a vice president at Dimensional Fund Advisors, where he started in 2004 after finishing his PhD in economics and finance at the University of California, Santa Barbara. During his tenure at the firm, Apollo had gained experience in a wide variety of practical subject matters. He's currently Dimensional's, quote, secretary of explaining stuff, and in this role, he frequently presents around the country and the world at financial advisor, professional conferences, and individual investor events. So to get us started today, Apollo, can you talk a little bit about Warren Buffett's advice to retail investors, specifically related around his comments that retail investors should simply buy and hold an S&P 500 ETF?
Yes. Hi, Blake, and hi, Keith. Thank you so much for having us, and thanks to everyone for attending this webinar. And I think that advice that Warren Buffett has been given investors really draws its roots from a bit of an incident, not one incident, but a situation that arose maybe about 10, 12 years ago, in which he was challenged by a professional money manager hedge fund out of New York to a bit of a bet in terms of his strategy, because Warren Buffett has been advocating this idea of let's just buy a diversified low-cost basket of stocks through the form of an S&P 500, which tends to be the most popular way to do it. And the other part in the bet basically suggested that he can do better than that S&P index if you have the skill, the knowledge, and the resources. What ended up happening 10 years later, because the bet was over a long run of about 10 years, what you saw is that Warren Buffett's suggestion that an S&P 500 index would do better, and indeed it did, relative to the performance of the carefully selected investments by the hedge fund. And by the way, that bet was in the form of, I think, about $1 million, and it was reported by Forbes, and there are quite a few details at the time. So that bet is over. Since then, Warren Buffett has once again kind of reiterated it over and over to investors that his belief is that you're better off not necessarily going into individual stock picking strategies, but rather sticking with broadly diversified, low-cost investment options. And that is the gist of what he's suggesting, is that based on this bet and based on his views, is that the market has changed enough where this strategy of individual company selection is no longer what it used to be. And you are better off served with this different approach. So is that's kind of genesis. And if I were to take a minute to elaborate on that and where it basically comes from, is for many, many years, the idea of a successful investment, if you want to call it that way, is the notion that in the stock market, and let's just say the square encompasses all the stocks in the market, successful investment experience depends on the ability to cherry pick and select just the right investments, and just buy those stocks, buy those investments that are going to fly high and make you a lot of money, and leave out everything else. And that has, over the past 100 years or so, has become known as stock picking. And the fundamental premise is that let's just go ahead and find just the good companies, leave out everything else. And this whole system that Warren Buffett is right now kind of setting aside is actually something that his mentor has been advocating, and something that he himself had done for a long time. And his mentor was Benjamin Graham, and he learned, and he gives Benjamin Graham quite a bit of credit for the things that he learned. And what the idea is that in the market, for every buyer, there has to be a seller. So there's a competition there. And if you work harder, if you study the numbers, if you understand everything about a company in a superior way, that ought to give you a competitive edge. Go and trade. because, as I said, for every buyer, there has to be a seller. So the idea is that gain a competitive edge by doing your homework and be unemotional, look at the numbers. And that certainly was a recipe for success for Benjamin Graham and for Warren Buffett. So why is it that today that strategy is no longer as valid as might have been like 50 or 60 years ago? And the main reason for that is that, a while ago, 30, 40 years ago, the majority of trades in the market, when you look at the data, were placed by individual investors. And there are only a handful of, not a handful, but there are a minority of professional money managers who study the numbers. And by doing so, they might have created a competitive advantage for themselves. So in that respect, by being in minority, they're able to maybe go and pick some pockets from these more naive individual investors. What we've seen over the past 40 years is just a staggering growth in the financial industry, to the point where today there are more professionally managed mutual funds in the US than actual stocks trading on the market. It's not competitive out there, it's hyper competitive. So we have moved away from the type of market that existed 30, 40 years ago when you might have been able to find somebody more naive. But it is no longer the case today. The second thing that's changed beyond how competitive the markets have become is that used to be that information, it still is the case that information generates that competitive advantage. And back in those days, some managers maybe had the ability to just get information better or faster or process it in a better way, and that gave them the competitive edge. Once again, that changed because right now, whether it's because the playing field has been leveled and everybody has to get information evenly, you can't have some information that flows to some people earlier than others. The computers and the internet has made this almost instantaneous that anybody can get a piece of information. In fact, there's overwhelming information out there, and because that information is so widely available, it's harder for somebody to consistently find nuggets that everybody else have missed to create that competitive advantage. So in that respect, that system that might have made Warren Buffett a lot of money, that might have succeeded for somebody like a Benjamin Graham, today is no longer state of the art. In my opinion, it's a little bit like, you know, blockbuster video in the age of Netflix. It might have made sense at some point, but not right now. Not in the world that we live in today. And there's a third element. The third element has to do, and I'll touch on this on the institutional side. It has to do with the risk that you're taking when you place pretty concentrated bets into a handful of companies. Because if you want these companies to make a difference, you need to place a pretty big bet on them. And when you do this, there's absolutely the chance that these companies might do what you expect. They fly high, and then you make a lot of money. And there's no doubt about this. These companies, though, if you concentrate, you also create a type of risk that's called unsystematic risk, which means that it's a very company-specific risk. And when you have this type of risk, which can be diversified away, but if you just hold these companies in concentrated positions, it is possible that you could go all the way to the other end. And that's what happened to, a close family member of mine that was very concentrated and he ended up losing everything. So that's the idea that when you do this, you really shoot for this. You want to make a lot of money, change the wealth status, but the range of outcomes is quite huge, from making a lot of money to going down in flames. So that's the system that I think Warren Buffett used to suggest, something that helped him make a lot of money back in the 60s and 70s and the 80s. Today, what he's advocating in this system is one in which you don't actually have to place these concentrated bets, where you do own these companies. But the idea that Warren has had is that instead of trying to place great emphasis on this, why don't you buy them in a way that are alongside many other companies that eliminates this unsystematic risk? And then at that point, you have systematic risk across the entire market. But what you do is you diversify enough, and you don't, and you're not exposed to the individual company risk. And how diversified can you be? Right now, in portfolios that are quite typical out there, and I know that there are some that you can look up on the web, it's not unusual to have over 12,000 companies in a well diversified portfolio in over 40 different stock markets. So in that respect, how much can any one company impact significantly, meaningfully your wealth? And the reality is that not as much. So this system that Warren Buffett has been advocating is one that in a way shrinks the range of what can happen with the outcomes. And if you have 12,000 companies, it's actually quite unlikely that all of them would go down at the same time, and then we probably have a lot bigger problems. So you kind of taken away this system, this left side of the equation. But on the other hand, you also take away that expectation, the hope that that one company is going to change the world status and make you a lot of money. So that's in a nutshell what Warren Buffett is advocating. Don't fish by the net. Don't fish by the rod, by the way. Don't fish by the rod. This is the individual stock picking, but fish by the net. Don't be interested in any one fish. Try to understand the behavior of an entire school of fish. That's the fundamental premise of what Warren Buffett has been doing. And in that respect, that starting point is still absolutely valid. So I wanted to give some perspective of where Warren Buffett's advice comes from, but that's a starting point. And from here, perhaps what we can talk about is the question that he actually asked that it took me a while to get to, which is how do you go beyond Warren Buffett's advice? But to me, this is the genesis of Warren Buffett's advice. The world has changed. Things that worked 30 years ago, they're no longer state of the art today. There's a way to manage risk a little bit better. And one more thing that was kind of implicit into what he's saying is that a lot of times these types of funds, if you hire a manager to cherry pick stocks for you, a lot of times these funds tend to have sort of high fees. Whereas if you buy funds that are much more broadly diversified, market-based, like an S&P 500 index that he's suggesting, they just happen to have lower cost. So the cost of investing have been reduced by these funds, and many times so it could be said about tax efficiency. Not in every case, but generally speaking, these funds could be more tax efficient, particularly if wrapped up as an ETF. So that's the genesis. So how can you go beyond Warren Buffett's advice? Well, there's a place to start in thinking of how do you move that. In capital markets, and we're talking about capital markets here, there are two distinct forms of investment. The first one is stock ownership. And this is what we've been talking about so far. And what is stock ownership? You're basically, if you buy a share of a company, a share of stock, you own a piece of that firm. And because you're a part owner, you are now entitled to part of the profits that the company stands to make. Now, what you're basically doing is you're paying today some money, you're exchanging today's dollars for some future dollars that you will receive as the company makes money. The thing is that the company doesn't have a guaranteed stream of profits. Profits fluctuate. And because profits fluctuate, so does the value of what is that company worth it. And that's why you see these fluctuations in the market. The one big instrument that you have is buying ownership in companies. And as the company makes money, then you as an investor get rewarded. But it fluctuates a lot because we don't really the companies don't have a way to guarantee profits. And as we know, things go up and down all the time. But this is the stock market. And that's where the S&P 500 would fit into. And if you look over the long run, and we have this book, it's called the Matrix book. It's a big book of numbers, a big book of data when it comes to the markets. What you see is that over the long run, the stock market has given investors a return of about 9 to 10% per year on average over the long run. But from year to year, please don't expect that. From year to year is very, very choppy. And that's kind of the nature of the market. Profits fluctuate, so does the value of a stock, and so does the value of the stock market. And that's the S&P 500. That's the growth of the S&P 500 over the long run with a lot of choppiness around the average. it has also been a very rewarding ride. If you look in this book at the growth of a dollar going back to the 1920s, that $1 would have grown to about $7,000 through the end of 2018, based on the book from last year, the Matrix book from 2019. A significant growth in the market. So that's what Warren Buffett is saying. Start with this idea. Start with the idea that you're buying fluctuating profits. It's been a very rewarding ride for investors. And that's your starting point. So what do you do afterwards? How do you go beyond Warren Buffett's advice? Well, the first place to start is to realize there's a second class of investments, and that is not buying ownership in companies, but rather lending your money to corporations and the government, and different governments for that matter. And when you do this, there is a contract in place that specifies an interest rate that you will receive, for how long you receive the interest rate, and at the back end, you get your principal back. That is called a bond. And in that respect, as opposed to the fluctuating profits in the stock market, for bonds, you know exactly what you're going to get because it's spelled out in the contract, generally speaking. And if you, let's say, deal with the US government, you lend them the money for 30 days. And after 30 days, you end up getting the money back plus interest. That is called the US 30-day Treasury bill. Over the past 90 plus years, there has never been a single calendar year when you would have seen a negative return, a lot less fluctuation in value, and you also happen to stay ahead of inflation. Long-term inflation in the US has been about 3%. These have paid investors something in the order of 3 to 4% on average per year. So the first place to go beyond Warren Buffett's advice is to say, if my risk preference is that I don't like to see these fluctuations in my statement, or if I'm getting close to retirement and I don't have a pension, I have to live off my investments, and I don't want to really just run through the roller coaster of market returns from year to year. One thing that he can do to go beyond Warren Buffett's advice is say, well, maybe a portion of my investments should be in bonds, maybe. And that's the first place to say, because Warren Buffett's is only addressing risk from the perspective of don't buy individual companies with this unsystematic risk, but rather buy a basket of them so you can just only have the systematic one. But it's not addressing the idea of what if you get close to retirement? What if you don't have the stomach for the stock market? And the first place to go beyond Warren Buffett's advice is really to have some bonds. And again, bonds are really, in that respect, they're really good diversifier relative to stocks, because they're a different type of investment. Now, to make sure that we kind of get the right perspective, if you invest the same dollar over the same time period in these 30-day Treasury bills, over the long run, instead of $7,000, which is the growth at 9-10%, if you were to grow at 3-4%, the Matrix book also gives us the answer for the growth of Treasury bills since 1920s, and that number is a whopping $21. So a very big difference between stocks and bonds. So it really depends what you're interested in. Now, beyond the $21, there are different types of bonds, and perhaps if we have time, we'll talk about this. And some bonds that are issued by governments like the U.S., but there are other issued by companies that are some more risky than others, more certainty in terms of getting repaid. Some are for a year, some are for 20 years. So there are different types of bonds, and if we have time, we'll look at it. But when it comes to an institutional investor, one of the first decisions they make is what is the allocation between stocks and bonds. That tends to be one of the most important decisions that you can make in the portfolio. Stability of bonds versus the growth in stocks.
Thanks, Apollo. That was a great explanation. I'm curious how tying in a financial plan and projection plays into that decision-making on the mix between stocks, bonds, and cash and other asset classes. And essentially, how does financial planning play a role in determining what an investor should own in their portfolio?
Right. And that's absolutely the right question to ask. because, quite often, people might be tempted to ask, well, how much should I put in my portfolio? How much should I do in stocks versus bonds? And it's a very common question that I get. And the reality is that the only way to know how much you want to put in stocks versus bonds, the only way, in my opinion, to know is to sit down with a financial advisor and, based on your personal circumstances, create a financial plan that takes into account how old you are, how much money you have, when do you need the money, how much money do you need, do you have a pension or not, what kind of job do you have, is it in sales or is it a university professor, a lot of things that really matter. And then once you have that financial plan, that what you want to do is find, how can I get from point A to point B of my financial life, with sort of like, making sure that I don't take unnecessary risk. And that is the only way, in my opinion, to know what's the right balance. And a financial plan is, in my view, is probably the best way to determine that, and have a qualified financial advisor, somebody like Keith or Blake, really look at your situation and determine, based on your age, based on the job you have, based on the pension you have or you don't, this is the right allocation. That's the only way, in my opinion, to do it, is to sit down and have a financial plan. And like you and I can talk forever about the considerations that go into the financial plan, and that's why there's typically a discovery process before all of these go into the hopper to analyze what would be optimal for your specific situation.
Apollo, thank you for those comments and that sort of excellent summary in terms of Warren Buffett and investing for our listeners. For those of you who listened today, thank you for joining us. As you might have pictured or understood, we do think that a financial plan is important, especially in these days of the coronavirus. So if you need advice, please reach out to us. We'll send you a follow-up email and give you a call. Again, thank you all for participating. And Apollo, thank you especially for sharing the dimensional perspective.
My pleasure. Thanks for being here.
All right. Goodbye.
Thanks, everybody.